Today I want to talk about mortgage rates because, as we all know, there's a lot of crazy stuff going on in the world right now, and it is always good to understand what is going on around you. None of this is going to be financial advice. I'm just talking about some random stuff here. Hope you guys can get some knowledge from it. But they are increasing. For the past 5 weeks, we have seen mortgage rates go up over and over. This week they've taken a little break and gone down, but as we all know, there's some crazy things going on in the world right now. Or maybe the war that is going on here.
We should have done this a long time ago.
That could be causing some issues. So, as we can see, they have been rising 5 weeks in a row, but have just now dropped a little bit. Again, I don't have high hopes that they're going to keep going down. They have always historically, in these kind of situations, gone up with everything that's going on in the market. But let's begin with our first type of loan everyone should know about: conventional loans. This is what everyone uses. 90% of people, this is where you're gonna fall, all right? So all a conventional loan means is that it's not backed by the US government. You can get it from any mortgage lending agency. So a bank, a credit union, anywhere you go, they can offer a conventional loan for you. So in conventional loans, there's two major ones you need to be made aware of. So our first one is a fixed rate mortgage. As you can see by the lock, that means your fixed rate. Your rate is fixed. That's all there is to it. You know, you want to buy a gamer house, you want to buy a regular house. I know we all want the gamer house, ideal setup right here. But either way, if this is you, this is what you want to go for. It is fixed for everyone. 90% of people use this. It comes in two different types: a 30-year fixed and a 15-year fixed. There are a couple other ones, but these are the main ones I'm going to cover. It is a shield against anything that happens. Say there's another war, any of this stuff that goes on, you are protected because you have locked in that rate with that lock. They cannot change it no matter what happens. That is what you pay. It is consistent. Everyone knows what they're going to pay at the end of each month, so you're not surprised if anything goes wrong. If rates drop, that is a great thing. You can always refinance to a lower one. It just means what you get at that time is what you get. Your principal and interest will never change on this loan. This is exactly what you signed up for. You know what you're paying, you know how long it's going to take, and nothing will surprise you. This is what you should use if you're buying a home today. This is what everyone should use. In the 30-year loan, you're just going to overpay a little in the long run. In a 15-year, you're going to get less of that interest payment. Again, remember, about halfway through your payments is when your interest and your principal are going to switch. The first half, pretty much, of paying off your mortgage will be all interest. It's not going to really do much against that lump sum you owe. Now, what if that sounds terrible? You lock in a 7% interest rate and no one wants to pay that. That's all interest. No one wants that. We have the ARM payment. And what does that mean? The adjustable rate mortgage. So let's say today mortgage rates are too high, as we have seen, and you want to lock in a lower mortgage rate. You do exactly what these people are saying. You seek a lower rate. For an adjustable rate mortgage, they always will have a lower rate to begin with if you're lucky. And they are on the uptick. As you can see, more and more people are using this. It is riskier, so keep that in mind. So what is the ARM specifically? It starts you with a lower rate than what is currently on the market. So let's say if your conventional mortgage fixed rate is 5%, they'll try to give you a half a percent to a percent lower, which is terrific. That is what you want, something cheaper to drop your payment. But after 3 to 5 to 7 years, you know, they'll set the timeline for you. It will change. It will go to whatever the current rate is. If you're lucky and that's lower, you've lucked out. The rate is lower, your rate lowers, your monthly payment lowers, and it worked out exactly how you want it to work out if you use an ARM. But let's say it hits the cap. There's a cap limit on these loans, so they can't just shoot you up in inflation all the way. And if you hit that, your monthly payment is gonna jump a lot. This is a risky loan mostly for investors, stuff like that. There's a few different ones: a hybrid ARM, an interest-only ARM. So let's say you just want to pay the interest on your payment. You're an investor, you're looking to just move a property quick. This is a great option. If you just want to lock in the interest and you want to flip the property before you make any real payments on it, if you think you're going to add a lot of profit into the property, this is a great way to pull that equity out. So for ARMs and conventional loans right now, the limit is going to be $832,000. So what is next? The FHA loan. FHA loans have a very low barrier to entry. This is a first home buyer loan right here, 3.5% down. It is also, if you're this guy and you make zero money, as he says, Sam Altman of OpenAI, this is a great loan for you because they're very understanding with down payments with only 3.5%. Or the ideal, you want a house hack, This is a great loan for house hacking. You want to buy one unit, live in the other three. This is a great loan for first home buyers. The only thing, it has to be on your primary residence. You have to live in one of them and rent out the other three. You can always refinance later to something else, but until then, you have to live in it for a year. So, FHA loans, what are we looking at? Low barrier, 3.5% down, like I said. This is great if you don't have a lot of money. You're the CEO of OpenAI and pay yourself nothing because you're a saint. This is what you want to go with. You have to have that mortgage insurance, that private mortgage insurance, because they don't know if you're going to pay it. You have to pay some insurance on it just because you have so little equity in the deal that if something happens, it can cover the difference on the bank. You're not the one taking all the risk on this, so is the lender who's lending you the money. What can you afford with an FHA loan? $541,000 is going to be the low cost area max. If you want something really nice in a really low cost area, that's what you're going to want. And it can go up to 1.2 million in high cost cities. So if you live somewhere, New York, Miami, LA, it can cover even those nicer houses if you're living there. Or if it's a multiple property unit, if you have multiple doors there, you can really cover a bigger property, get that full 4-door discount. And you can refinance this loan with an FHA Streamline Refinance. It is a no appraisal, no income verification refinance, just to try to help get that lower rate if you think they're coming in the market or if you see that they are there for you to take. This is only if you have an FHA loan already though. You have to have the FHA loan in advance. So what's next? The VA loan. This is a terrific loan, probably the best loan on this list if you can qualify for it. This is 0% down for veterans. Everybody wants this loan, and a lot of people who can qualify for it don't even realize they can. So if you can qualify for this loan, please go take out this loan. It is 0% down, and you don't even have to pay the mortgage insurance like an FHA loan. It even has its own refinance method called a IRRL. It is a interest rate reduction refinance loan. So if you have a V8 loan, the rates go down, you can refinance to try to lower that monthly payment for yourself. You have to be involved in a VA bank that does this kind of business. Also, working with a realtor who knows a lot about VA loans can also be beneficial. It is a more niche market because, again, there's not as many home buyers that have also served in the military. But if you can get this loan, please go get this loan or refinance your loan into this on your main residence. It can only be on your main residence though. No investing on this one. You can later when you move out, keep that 0% down payment, refinance into something else, and you can rent out that property. But let's say you're looking for something a little different. You don't want that city life. You don't want the hustle and bustle. You like these views and the cows. What do you do if this is what you're looking for and you want to walk down a long path to your beautiful farm? Well, it doesn't just have to be a farm. This can also be rural areas. This is the USDA loans. So this is more of a geography loan. If you're moving in an area where they're trying to encourage people to move, to build up an area, they will give you this loan with 0% down. And again, no military, no anything for this. They just want people to move there. So you have to check that your area allows this. And this can just be the suburbs, as we see. It doesn't have to be a rural area. You'd be surprised some of the places this qualifies for. You still need some mortgage insurance as a guarantee fee, but much cheaper than FHAs. Important things to know about the USDA loan. As good as it sounds, they are making improvements, but there is a income cap for this. For a family, if you have 4 income parties in your household, the cap is $120,000 in most area. Or if you live somewhere, or if you're looking for houses somewhere, you are making more than 115% of the average income in that area, you will not be allowed to qualify for this loan. This is only for primary residences, not for investors. It is also a very picky loan. The house has to be in good shape, no leaky roofs, no fixing up. They kind of just want a safe bet to get people to move to rural areas where they can build up that area without a lot of risk on their end. But if you can, this is a good thing they're improving on, a good thing to get involved in. What if you're like this guy here, a little bit of a whale? I want to talk about whales for a minute, don't you guys? What are whales in mortgages, you might ask? Well, they're kind of like this guy. If you recognize him, Bill Gates. He would be one of the biggest whales there could be. But probably more we're talking about your rich grandpa here. He is looking for something a little nicer for himself, you know, something to settle down and to retire. So what does he do? He takes out a jumbo loan. This is for houses that are more expensive, that those conventional loans at the cap cannot cover. If you need $1 million for that mansion, something nice, or if you live in nice cities, like we talked about, New York, LA, Miami, maybe not nice, but expensive cities, this is where you're gonna wanna look. It is hard to get though, I do wanna stress that. You need a lot of income verification. They will check back 2 years at everything you've ever done to make sure you can qualify for this. You need a very high credit score. This is a hard loan to get. You also need a lot of capital. They want to see you have 12 months of capital saved up to pay for this loan. You have to be pretty liquid, have a lot of money. Great option for that though. If you want to know the number one use of this loan, it will be luxury Airbnbs. If you're looking to invest in that type of stuff, this is your loan. You just need to really prove that income, really prove that you're making money, can support the Airbnb if there's any vacancies, anything like that. But it's a good way to get those luxury properties to then invest some money into. Now, what if you like to scale? What if you like to play for the late game here? You're not an early game champ. You know, you want to play for your late game, play a little passive. This is for some investors or if you're unemployed, all right? It really can go either way here. This is, of course, the DSCR loan. Passive income. So with this, they use this equation here to really determine if you can pay for this house. But you can use the house's income it might generate for you as your income verification for the loan. So say you want to buy a house and rent it out. Your monthly payment's going to be $3,000. You're going to charge $3,000 in rent because you hate people who have to rent, right? You're going to break even and the bank will see that and understand you're going to get that rent. They will use that income you're going to generate from the rent as proof that you can pay for the property. Now, you might be saying, sounds too good to be true. I can just buy any house and rent it out? Yes, but it has a higher interest payment. And it all hinges on this single number right here, your ratio. If it does not look good to the banks, they will not approve it no matter what. This is not for first-time home buyers. This is an investor loan. So this is great for scaling. If you want to buy more properties, if you don't have a good way to prove you have the money to buy it, you can say, I'm renting this out. This is the income verification I have for it. So in 2026, DSCR rates have dropped to 5.8 to about 7.3%, and you can own unlimited properties under an LLC with this loan. So you can really scale up quick here. Just be careful not to get over leveraged, have a lot of debt. No one wants to be in that situation. And again, this is an investing property. If your property goes up in price, you can refinance this loan and get some of that cash out to put down on your next property. There's no debt to income check on these loans. That's important for investors because you might have a lot of debt, but you're paying it off at a good pace, as we know. So just make sure you go to the bank. They see that property is going to cash flow. That is what they care to look at. Again, this is a very high risk loan at the end of the day. If that property sits empty, you are responsible for the mortgage, even if it is empty. And that can be a big ticket payment because the interest rates on these loans are higher than normal. Because again, it is a risky loan for both you and the lender. End of the day, it's about 1 to 2% higher for interest rates on these loans. Now for our last one, I want to talk about the HELOC line of credit for your home here. So what does that mean? Imagine this, imagine a credit card that you can just swipe over and over. Little chip there. Over and over. As much as we all like credit cards, we all know the risks of credit cards. You own a house, you have a lot of money in that house, and let's say you want to add on an additional dwelling unit on that, an ADU. You can go to the bank and say, I have all this money on it, I would like to take it out and build this. You might be saying, this sounds like a home equity loan. The difference is this is a revolving credit line. You can take it out whenever you want, but the rates will be whatever they are at that moment. So they can change very quickly if something happens. Whereas a home equity loan, you can lock in that rate right when you get it. But again, this is terrific for scaling. If you're investing, really trying to get your money out quick to move on to the next project, to improve it, and you can know you can get that money back, this is much safer to go with. And you can get a more versatile amount of money out. With a home equity loan, you set exactly what you want to get out of the home, $100,000. With this, it's a credit card. You can keep coming back to it, but you just get charged that upgraded rate every time. With this loan, again, they do not care what you do with it. You can take this money out and take it to the casino, put $100,000 in and lose it all, and you're still responsible for it. So again, don't do that, but you can if you get lucky. But again, this is a variable rate loan. If federal rates hike, your payment will explode and you might be drowned in that debt. So again, this is a quick turnaround, renovations, pay it off, appraise your house again. This is where you want to go with that. So my final question I have for you is the classic red pill, blue pill. There are a lot of safe loans in here, a lot of great loans for first-time home buyers. Which one are you choosing? Subscribe, let me know.